Greetings and a warm welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA channel and CEO at Trout, TPSU, and 401k TV. I review all of this week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story. As convergence of wealth and retirement at the workplace continues to gain momentum, a major topic at the recent RPA broker-dealer roundtable, as well as the June record keeper roundtable, how to manage and utilize participant data becomes critical. To that end, Broadridge, which acquired FI360 in 2019, and helps firms manage data, announced the acquisition of iJoin, a fintech that helps advisors and record keepers leverage that data. As more record keepers are making participant data available to partner firms, as well as trying to figure out how to offer wealth services to their participants, firms need help managing the data and making it actionable in a timely manner, which is what iJoin has been focusing on the past few years. Along with capturing IRA rollovers and offering managed accounts, iJoin is enabling the industry to offer retirement income solutions. PenChecks, which partner with iJoin on an IRA rollover solution, Next Level IRA, recently won a Wealthies Award for this initiative. Next story. 401go, a fintech record keeper, announced an innovative program to match advisors with plan sponsors, which will become increasingly important as plan formation explodes due to state mandates, tax credits facilitated by group plans like PEPs. Though some have been skeptical of fintechs like 401go, calling it an unsustainable business model, someone must deal with these smaller starter plans, which most legacy providers struggle to profitably serve, which likely prompted Hancock to partner with Vestwell recently. With Guideline now part of Gusto, the opportunities for other fintechs increases, especially for innovative firms like 401go, as the sale of Guideline validates this business model, likely to lead to increased investments and deals. Next story. Fidelity Investments released their 16th edition of the Plan Sponsor Survey, which showed that 92% of plans now work with an advisor. Chris Alpo, head of Fidelity's DCIO channel, stated that Plan Sponsor focus has shifted to advisors that engage and help participants to improve outcomes, with a whopping 93% of plans implementing financial wellness programs and 2/3 stating that it has been very impactful. Data on what percentage of plans are expected to switch RPAs was not collected this year. The survey was conducted this past January with 1,144 plans with over 3,025,000 employees, 80% under 250 million, and 44% with plans 50 to 249 million. These plans were not necessarily record kept by Fidelity, which was not named in the survey conducted this past January. Next story. As the frothy benefits, P&C, RIA, and RPA advisor market, M&A markets continue to percolate, Lincoln Investment, a 1,000 employer investment banker, announced their intent to acquire Marshberry, the leading benefits and P&C investment firm. Looking to expand their RIA and RPA footprint, Marshberry hired Rob Medor in 2023 from the Wise Rhino Group, which focuses on RPAs, with their founder, Dick Darien, retiring recently. Larger benefit shops like Hub, One Digital, Marsh, Mac, and Gallagher have been successful cross-selling retirement plans to benefit and P&C clients and continue to acquire them, as well as wealth shops, as convergence of wealth, retirement, and benefits at the workplace continues to explode. No banker has been able to establish a major foothold in more than one market, but with greater resources, perhaps Marshberry now can. Finally, with the DC world abuzz with talk about private investments due to the recent executive order, skeptics like Senator Elizabeth Warren have questioned their suitability, while others wonder whether there is real demand. To those points, Apollo president Jim Zelter, whose firm partnered with State Street on a target date fund, stated that they will take a cautious approach when offering private equity to DC plans focused on investment grade rather than more volatile equity strategies. As the industry awaits guidance from the DOL, some advisors are seeing real demand from C-suite participants who might have private investments in their personal portfolios, as well as younger participants who have a longer time horizon, less concerned about liquidity and volatility than those closer to retirement. So those were the most important and interesting stories from the past week. I listed a few others I thought were worth reading, covering AARP joins lawsuit against TIA as allegations expand in an amended filing. Michael Kitchis says tech is not materially lifting advisor productivity. Lincoln hires longtime industry veteran Jason Crane to lead their retirement services division. J.D. Power digital study of record keepers reveals increased focus on security, and T. Rowe releases their annual DC consultant survey. A note about the Manulife John Hancock recent Pantera announcement, which many media outlets have characterized as a partnership. Rather, it is a collaboration to create efficiencies for advisors to improve outcomes. Still a really big deal. So please let me know if I missed anything or if you'd like to comment. Otherwise, I look forward to speaking to you next week on 401k Real Talk.